Most investors get super excited about how much money they make in the stock market. But you know what many really forget? It's not just about those big gains, right? It's about what you actually keep. Because, seriously, it's absolutely wild how much of that money can just disappear into thin air. If you're not paying attention to things like sneaky fees or taxes, and believe it or not, one simple mistake can make you pay way more in capital gains taxes than you need to. Let us break down short-term versus long-term capital gains and see how knowing the difference can help you build a smarter, more tax-efficient portfolio. First things first, let's cover the basics. What exactly is a capital gain? It's pretty simple. A capital gain happens when you sell an investment for more than what you originally paid for it. So, let's say you buy a stock for $1,000 and later sell it for $1,500. Your capital gain is that $500 profit. But here's the kicker. The amount of tax you pay on that gain depends entirely on how long you held the investment. Now, let's talk about short-term capital gains. If you sell an investment after holding it for 1 year or less, any profit you make is considered a short-term capital gain. Short-term gains get taxed at your ordinary income tax rate. That means they're taxed at the exact same rate as the income you earn from your job. For a lot of investors, this rate can be significantly higher than the long-term capital gains tax rates. This is a big reason why frequent trading can rack up a surprisingly large tax bill at the end of the year. On the flip side, we have long-term capital gains. If you hold on to an investment for more than 1 year before you sell it, the profit becomes a long-term capital gain. And this is where it gets good. Long-term gains are typically taxed at much lower rates than your ordinary income. For many people, these rates can be as low as 0%. For others, it will be increased based off of their income level. Because of these favorable tax rates, a lot of long-term investors make it a goal to hold their investments for longer whenever they can. Let's look at a quick example to see this in action. Imagine two investors, and they both make a $1,000 profit on a stock. Investor A sells their stock after just 6 months. Investor B waits and sells their stock after 18 months. Investor A is likely going to pay their ordinary income tax rate on that $1,000 gain. But Investor B, they'll probably qualify for the much lower long-term capital gains tax rate. Even though both investors made the exact same profit, the amount they actually get to keep after taxes could be very, very different. This is exactly why taxes play such a huge role in building a tax-efficient portfolio. Many savvy long-term investors focus on strategies like holding their investments for longer than 1 year, using tax-advantaged accounts like 401ks or IRAs, and just cutting down on unnecessary trading. These strategies can potentially help reduce the amount of tax you pay on your investment gains over time. Ultimately, understanding how capital gains taxes work is a really important part of being a smart investor. Because in many cases, it's not just about how much money you earn, it's about how much you get to keep after taxes. If you found this helpful, consider subscribing for more simple explanations about investing and personal finance. Thanks for watching. Just a quick reminder, this content is for educational purposes only and shouldn't be considered financial or tax advice.